All right, give me just a quick second. I'm responding to some messages. There's a lot going on in the background right now after hours. So, and I got 2 minutes to let everyone come in, but if you guys look down below in the description, you guys can see the timestamps of what we're going to be talking about here. Nothing too crazy. All right, let's see. Okay, and actually, let me make a trade here. Okay, so pretty crazy stuff. I had to do a quick response. Damn, that's a disgusting pie chart. All right. Fabio has pooped out 1/4 my paycheck today. That was yesterday. Okay, hold up. Getting that was tough. All right. We got, oh, okay. No, we're on the 5-minute mark. All right. So let's get started. Let me get the list here so I can have our conversation. So right now we're going to be discussing the first bit of stuff. Again, description below so you guys can see. I'll also talk about some of the links there. But let's get into the Fed rate cuts. So kind of as we thought of was going to happen from the get-go, it happened. And I put out a tweet kind of jokingly saying, like, the thing that we all knew was going to happen was totally priced in, right? And then it happens and we get we get some interesting price action in a lot of our stocks here, and specifically the financial space that seems like they weren't pricing in sort of like a spread trade. But here we are, and we'll talk more about private equity when we get to the private equity section. But if you guys remember, I did a live stream talking about the 4 main pillars driving the market down. And remember, we had not a lot of, let's say, index participation in the drawdown. The indexes never really went down that much. But if you actually seep through the actual names in the index, there are plenty of stocks actually off of 30% off their highs and the like. And so there was a lot of weak participation in the market. But the 4 main narratives being consumer driven, so consumers dead, right? Private equity bubble or private credit bubble, which was very strange in how it was formulated, because just like who the participants were in all that with the tricolor fiasco. There was also the employment narrative, right? And gosh, now I'm blanking on it wasn't inflation. There was another one. They're just all so silly that, AI bubble. That one was another one. So we'll get into, and that one's actually making a resurgence with Oracle just a little bit, but not in the same veracity as before. Okay. Let's get into the other point of conversation, because I got to make sure I cover everything, because I didn't give myself a lot of time in this topic. But I did put out a tweet today talking about the Mexican-China tariffs. So if you guys recall content we made back, I think close to April, May, really discussing the framework for all this. I put out, I think it was like a 3-hour live stream going over this. This is not new. It wasn't really supposed to be a surprise. A lot of the direction we were heading towards was more of an accordance with Mexico. For at least the Mexican economy, it's much more beneficial for them to tie themselves to the United States. They can do a lot of what was once done in terms of low value add manufacturing or for the United States. But this 50% tariff, which will be imposed January 1st, is to combat what we were observing, which was you would take products from China to Mexico, do a little bit of additional labor, and then count it as a Mexican product, or sometimes just completely circumnavigate it altogether. And so that's sort of just like a political alignment gesture, if anything. But people are maybe making a bigger deal out of it than it otherwise would be. So yeah, the other parts I'd say regarding the narrative is with this JP Morgan conference that they recently had. We were really confused by how people interpreted it. I'll show you my tweet actually, because it's important I show that. So you can kind of see what people were reading from it and my comments on it, because I just implore everyone to just look at it themselves. All right, so let me put this here. Okay. Let's go. Where's StreamYard? Share screen. Okay, so I made the following comment, but I just implore everyone to go read it. So this is what everyone saw. JP Morgan co-CEO Marina Lake says the consumer backdrop is a bit more fragile. Sees 2025 card charge-offs around 3.3%, expected Q4 IB revenue up low single digits, blah, blah, blah. And so the stock dropped on this result, or on this commentary. It dropped even more throughout the day. It's already recovered. But if you actually listened to the whole conference instead of just like reading headlines, like a person who doesn't read, then what you would have actually found is she talked a lot about the people jumping ahead of the data and the data overall being good. And the question actually asked was, where is this narrative coming from? And so she gave a whole explanation as to where she thinks it might be coming from. And I'm paraphrasing, but the gist of what she said was things still look pretty good, all things considered. And people were jumping ahead of the data, drawing up these narratives, which is how we felt as well. And so there's a lot of different businesses you could have looked at to also make the same conclusion, but narratives are very powerful. And, people spread it, including, that's partially why I say you don't even bother following accounts like this, because I think they provide net negative informational value. And, other places like Walter Bloomberg, it's just kind of like an algorithm that posts headlines. And even with that, it's pretty low value if you don't investigate further. So always consider, if you've already done the research, fine, but always consider that if you just take it at face value, you might make a mistake in your investing. And so I would not take really any of the things stated, by any of these accounts at face value, even though a lot of people retweet it, and then people just start parroting the same things again and again and again. And so that's kind of why I made like a call to action, was to just listen to it yourself before, taking that at face value. And like I said, it's kind of funny how the stock price subsequently recovered already that sell off. So if you panic sold it, good for you. That turned out to be a great buy the dip opportunity for JP Morgan. Absolutely, it was, because you took advantage of the fact that people just didn't read. And, that's always a great opportunity. Same thing what we'll talk about within the private equity narrative. Okay, and then so that pretty much covers, at least on a high level, all the different topics. But the gist of what you want to get from it, to summarize everything in the next 2 minutes, is, Fed rate came. I don't know why it was a surprise. Kind of the only surprising part is really how the market reacted. because they seem to be reacting towards like the guidance of what we were looking towards future rate cuts. But we know this transition that we're going to see right now, it's going to be more favorable towards rate cuts. So again, kind of surprising that it was any surprise. Number two, also kind of surprising that people are surprised about the Mexican tariffs on China. It shouldn't be surprising, really. Not very difficult thing to point out. And then the last bit is on JP Morgan, the conference. I actually think it's a good listen. I think everyone should go listen to it. Especially if you're a shareholder in JPM. So, go give that a listen, and then come back and see how this headline is a bit misleading. And there was a lot more context needed to kind of put the story together. Okay, so on to the next topic. We're going to be talking about Adobe earnings. So we're not going to spend too much time on this. There's a lot of people already talking about Adobe earnings. I did a live stream talking about the opportunity set for Adobe. It was pretty funny, if you want to say, that the timing of when we took the trade on Adobe and what happened subsequently. But really, a lot of the return from that trade came from Salesforce's earnings. So Salesforce reported earnings last week after we took the trade, and the results were pretty much in line with what a lot of people expected. AI is not killing them. AI is not killing Adobe in the same manner that people are kind of making it out to be. Especially, we'll talk a little bit about the deals that Adobe made recently with OpenAI and what that implies, or what the implications of that are. But for the most part, Adobe's earnings were more or less in line with, I think, what I expected, which is still some steady state growth. But the return forward for something like Adobe at the current valuation, which I see a lot of people getting the multiple incorrect, because when you look at the multiple in data aggregators, and I pointed this out, you have to be very careful between normalized earnings and real GAAP earnings. A lot of people keep quoting the normalized earnings or the adjusted earnings per share. That is incorrect, because the adjusted earnings per share in the case of Adobe, likes to remove things like stock-based compensation. Adobe is relatively cheap to fair value based off of its forward growth rate. But if you want to look at the adjusted earnings, it looks a lot cheaper. And so, of course, the management's like, yeah, look at the adjusted earnings. But when you kind of look at the actual GAAP earnings, which accounts for that SBC as a true expense, it's not as cheap as some people are trying to make it out to be. But it's not crazy expensive either. It is a distressed stock, not a distressed company. And what we're really kind of observing is this still pricing power as they continue to increase prices, improve on margins, et cetera. So the bottom line is going to accelerate faster than the top line. And what they're guiding for on a go-forward basis is a solid double-digit or low double-digit increase in the bottom line, with a high single-digit, even maybe potentially hitting double-digit top line. And really, the let's call it churn rate at Adobe still isn't anything alarming. So I don't really see like a cause for panic per se, but I will maintain that Adobe, it's kind of a fun battleground stock, that there's a camp says it's dead, a cult that's seemingly forming. So obviously saying that it's alive. And I'm more so of the opinion, I think, with my partner Andrew and Michael, that we see that, okay, yeah, it's cheap, but there's a lot of other really strong opportunities out there in the market. But we're not haters of Adobe. So as a trade, it was interesting to take part in. And the results today, again, most of the returns came from another company's earnings results, Salesforce. And then today was rather muted, all things considered. So, but can't really complain over the last week or so. We got some good questions coming in. So am I still bullish evolution? I'll talk about that in the Q&A. Adobe is ramping up buybacks. Yes. So as part of the capital return policy, it's still the case, and that's something I praised Adobe for. So the difference between some of the other stocks that I've covered or been asked to cover, when I was asked to cover Fiserv, Fiserv's buyback program was fairly toxic, especially if the forward estimates were wrong. The forward estimates were very wrong, but the buyback program was especially toxic given the amount of leverage they took on. And remember that not all the leverage was from the buyback program, but the fact that they were using some leverage for the buybacks, given the state of the company, was the toxic part. In the case of Adobe, it's a lot of unlevered buybacks. It's coming straight from cash flows. Now, they're doing a little bit more than the cash flows right now. So they are being a little bit more aggressive with the repurchase program at the moment, which I think if you think it's fairly valued to undervalued is a good thing. That should help or boost longer term earnings per share growth. And so that's a lot where it's going to come from. So your forward growth expectations, unless as far as a return as an investment, is either going to come from some re-excel in growth or multiple maintenance plus the growth expectation that you think. Unless you think they're, and you're just baking in some multiple re-rate, then okay, that's fair. But really, I don't tend to favor multiple re-rate stories just because it's kind of like, okay, what if you're wrong with what the multiple should be at? Because you're kind of just guessing the multiple. What if the prior multiple was wrong? Because both can be true when you're buying a company for a really low multiple and it re-rates to a really high multiple, or let's say a more normalized market multiple. Maybe the low multiple was wrong. But it could also be the case that if the multiple is really high at the time of purchase and it re-rates to a lower multiple, that just the previous multiple was wrong, and you don't want to anchor to that prior multiple and just assume that the market's going to take it back to that multiple. While it could, it's sort of like a inconsistent gamble, so to speak. So I think for the most part, dollars earned, there's some premium to stability and predictability, but I don't think longer term there's much more than that aside from assigned to forward growth expectations. So I think the most premium assigned to a multiple comes from what the forward growth estimates really come down to, rather than raw predictability, et cetera. Because I think, a lot of people, of course, you look at Adobe, and the reason why it's attractive, especially from a modeling perspective, the easiness of how it is to model something like Adobe makes it a little bit more, let's say, adds to the clarity factor. And you theorize, okay, that deserves a multiple, which again, I see the argument. But I don't tend to, jump over myself to try to, clamor and make it a massive position. All right. If I am kind of looking to the side here, it's because I'm very excited about a trade I have going on with Lululemon. So I apologize. I know Ann Andrew's coming in here to distract me saying 205. I'm really trying to stay on topic and keep my composure. But I apologize in advance if we have distractions in the comment section. Oh my God, Andrew, stop. All right, I'm not going to look at the comment section because then I'll start hyperventilating. I'm just kidding. It's not that bad, but but we could talk about Lululemon later. I want to stay on topic. I'm not going to. Why am I shot? You're not shot. All right, so I already lost my train of thought because you're making me look at Lululemon chart. I did post this today. I wanted to show, kind of a hint at what was to come. Not that, it could have gone either way, but yeah. Okay, so let me see. I'm still good on time. I think so. No, yeah, I have 4 more minutes before the next topic. So if there's any questions on Adobe, I'm glad to answer them. Otherwise, we'll move on to the next topic. But Adobe, long story short, to summarize the conversation, you could go far worse with another company. Good company, overly hated. I'm leaning more on the side of the bulls than I am on the bears. Bear arguments are overrated. I've been covering Adobe for a long time. I was, you could call me a former bear on Adobe, strictly due to valuation. I've been asked to look at Adobe multiple times throughout, since I've been on YouTube. And prior to now, It's never been a compelling offering. The growth really wasn't there relative to the valuation. It just didn't make any sense. Now that's sort of changed, and I think you could probably expect a market to slightly above market rate of return on a go forward basis from Adobe. And for a lot of people, that's attractive. I'd say it's also an attractive proposition for myself, depending on your confidence level on that. So some of the club members, right, they look at it that way. They say, hey, at the current valuation, I get slightly above market return, and I'm really confident in that outcome. So therefore, I should make it a quote unquote meaningful core position. And it's like, okay, that's a good argument. I can't really fault you for that. And so for anyone in the audience who's long Adobe, I'm psychologically more long with you than I am long, in terms of dollar or percent amount. Because I guess in dollar terms, it might be considered. But at the current moment, full disclosure, I'm out of the commons, and I only have contracts on Adobe. So that's the only thing that's remaining. But so that's the update from the last live stream. And so that will conclude the topic of today. I agree with you on what I feel as there's better opportunities out there. So, but it doesn't mean, when I say that, it doesn't mean that it's bad, is what I'm trying to say. So I'm trying to give a balanced approach. Thank you for the psychological contraction. Oh my gosh, Andrew, stop it with the updates on the numbers. This is crazy. Oh man. All right. I probably should have done this live stream either tomorrow when I have more composure, because it's never. Oh my god, 209. Well, I took my girlfriend out to a very nice dinner yesterday, so it's a very, very good timing. But it was more so because of yesterday. So this is just icing on. No, it's not time to ban Fuhat. The joke was we would only ban Fuhat if it was a bad result. You were wrong. You're already shot. Wait, who shot you? No. They're not allowed to touch you now, Fuhat. You're immune for being banned. Check your DM, or my DM. What's this? Oh my goodness. Well, I'm a huge fan of yoga pants right now. Oh, okay. I'm going to start. If your questions are about anything that's not on the topic, I'm starting them because I'll answer them at the end of the show. So the question on Mercado Libre, I will talk about them. For full disclosure, I'll say it now. We are long Mercado Libre, if that's all you want to know. But I will be talking about Mercado Libre at the end. So if anyone asks any questions, it's not on the topic. I just star them and I answer them at the end. So don't worry. If you're wanting to I'm going to shamelessly say it. I'm a retired or unemployed person now. So, donations go a long way. Intent, nudge, nudge. Also, check the description below for all the sponsors. If you need someone to help to do your taxes, yeah, we're sponsored by Strongman Personal Finance. And so there's two links. One to kind of check out the service and get a feel for it. Then the second one is to schedule a free consultation. I also have a link for the code that gives you, well, I can't speak because of Lululemon. Gosh dang it, Andrew. I cannot do this. For FinChat, which I only advertise services that I actually use, by the way. And then, of course, myself as another sponsor. So if you want to join the investment club, the link is also in the description below. All right, back to the content. You see, like, it's hard to focus. I'm telling you guys. All right, so GEV. So this is another play that I pitched this one inside Capital Mindset, and I did talk about it briefly publicly on Capital Mindset YouTube. But the thesis is actually really simple. It's predicated on this belief that energy investment is going to be a driving theme for many years to come. And so General Electric Vernova is perhaps is the centerpiece of this. So if you kind of think about ASML and its role in the actual fabrication of silicon or of semiconductors. GE Vernova is that, but for energy. And so what they do, to simplify things, is they produce the actual turbines that go into these facilities. Now, General Electric Vernova, they are booked from the conversations, not myself, but Andrew has had with folks in the industry. They are booked till like 2031. And the pricing power that gives GE Vernova is actually very underappreciated. Some of the things I'll kind of point out, I won't go into the numbers into too much detail here on this live stream. I've done that for the CM members, but it is a lot cheaper than what meets the eye, and there's a lot of reasons for that. Mainly, if you look at, for one contributing factor, the windmills. So right now, the windmills are a loss generator. And by 2027 or so, these are actually going to be, at the very minimum, if you model it out, break even. But what's likely going to happen is they're actually going to turn a profit on those. The reason why General Electric Vernova was actually up quite a bit on the day they announced an agreement with Taiwan for the wind business was because that gave us a glimpse, and we could then model out what it could then look like, what the profitability of that segment is going to be. And again, it's going to probably go from a headwind to a tailwind. But the real tailwind comes from the other two segments that are growing quite nicely. And again, with that growth and supply constraint that exists out there right now comes pricing power. So the margin improvements are there, and you kind of start modeling out revenue growth, margin improvement, all the like. You start to see that in just those two segments, forget the win for a second, it is deceptively expensive. It's been deceptively expensive. And so the market, I think understands that. Institutional investors, I think, understand that. Retail tends to be, unless they're more, let's say, inclined to study this space, tends to be a little bit like, oh, I don't know what I'm looking at, 114 PE, no thank you. And that's understandable. There's other investments out there that, if you bought, you're going to do just as well on. But this is one that I think will do exceptionally well over the coming years. Has done exceptionally well, since going public. But the investment in energy, I think this is like basically the centerpiece of it all. It's one of the true bottlenecks for that. And what we're going to have to do globally is invest a lot in energy infrastructure. And you don't really do that without Siemens, GE Vernova, and Mitsubishi Power. So yeah, that's the gist with that. Let me make sure I'm good on time and questions. Okay. Yeah, we're super good on time. All right, questions. Let's see. Following your channel for 5 years now. If I had listened to you, I wouldn't be broke today. Oh, well, I'm happy to hear that. If I listen, yeah. Well, I'm happy to hear that, man. Glad to see you stuck around for 5 years. Have I been doing YouTube videos for 5 years now? That's crazy. Time goes by fast. Wow. Lululemon up 209.19. All right, I'm not going to look at this. We're going to close that out. We're going to close that out. We can't stare at that. Okay, your takes on IPO, SpaceX, IPO, OpenAI, Amazon, all going public at $1 trillion. Great question. I will save that for the next topic. Or sorry, the Q&A. So if there's any questions about this stunk, I am more than happy to go over. Otherwise, we'll move forward. Show me your yoga pants on camera right now. Great proposition, but unfortunately, I'm not wearing any pants, right? Forget yoga pants. Wow, in a few weeks, 2021 will be 5 years ago. Yeah. Yeah, that makes you think, doesn't it? Okay, so Mag 7 lagging index this year besides Google and Apple and NVIDIA. Yep. We'll talk about that well, actually, that actually pertains a little bit to the next topic, which I believe, actually, not the next topic, but definitely the private equity. What I'm going to be talking about there. but I'll get into it a little bit here because yes, the Mag 7 has actually underperformed this year, mainly except for those names that you listed. Mainly because, you know, I think that the valuations got a little ahead of themselves at one point, and the fundamentals still are improving, especially for companies like Amazon and even Meta. And these narratives started to form around them. And to be frank, it's like Meta's had a great, you know, ride so far. So it's not like it's unhealthy for it to cool off a year or so. That's perfectly normal. And if people who have time frames longer than 1 year, this is like whatever. It's not let's say realistic to expect, you know, eye dropping or mouth dropping returns every single year on a stock for a decade. There's going to be years where, you know, it doesn't do anything, you're like with the stick poking it, do something. Other years where it does a lot, maybe more than it deserves. All you got to focus on, and all you can focus on, is how the business is doing, you know, underneath it all, and then paying attention and making sure that that's all right with you. So, yeah, great question, man. All right, I'll tag this. So, I can answer this one because oh, sorry, I clicked on the wrong one. I starred that one. This one. Hello, Fabio. Do we long restaurants at all here? CMG, Shack. Okay, so restaurants are really interesting because if you look at the category, a lot of it's lagged, and people pointed to that lag as being evidence of this like crazy weak consumer. When frankly, what I found, and if you looked at or listened to Toast and a few others, consumers are just changing their behavior pattern, and you know, maybe they're going less to McDonald's or less to Wendy's or wherever, but they're going more to that local restaurant. And so same store sales growth for some of these restaurants has actually been improving. Anecdotally, I know a few folks in the restaurant space, both in Capital Mindset Club and in the my local area, and both have actually been telling me the same thing. But I take, again, because it's anecdotal, I don't say, oh yeah, I'm going to draw a conclusion from that. But I started to notice that the two narratives were aligned, where I was hearing, you know, things weren't busy earlier this year, but things have picked up a lot. And we're seeing a lot with the discretionary spend category companies, right? We're seeing with the attainable luxury, non-luxury, and even like aspirational luxury. So not true luxury. Let me clarify those definitions because I don't want to make it sound snobbish. But true luxury, this is where it's, you know, it sounds snobbish. I just say it that way because you know, I try to create a separate category for Ferrari or for Hermes, but I say, you know, attainable luxury is more like, think of the categories that it's not a comment on quality, it's just a comment on pricing and targeting, right? But aspirational luxury, not being true luxury, is still luxurious, by the way. So I just don't want to, you know, confuse that with the nomenclature. But it's you know, think of Louis Vuitton and some of these other names that are in that price category, not yet Hermes, but just under that. And then they're aspirational products. They're not something you can buy every day for most people, but they're not in that. Just mentally creating this completely separate category that's just slightly above that, or even highly above that, in what I just call true luxury, or you might want to say, I don't know what you want to call it. You can call it hyper rich luxury. But within those categories underneath the hyper rich luxury or true luxury, we've been seeing a lot of comments about consumer spending actually improving, and all the way down through attainable luxury, and even, you know, some of the discount retailers that sell in bulk, like, you know, TJ Maxx, et cetera, saying the same thing about across the spectrum of consumers. Because some people might say, oh no, it's just a K-shaped economy, because that's another narrative we'll kind of dispel a little bit. We have been dispelling. I've been trying to attempt to make an argument against it because I think that's misleading. And we've probably just more been in a recession for a while now, going back to 2022. The AI investment cycle, this whole new sector of the economy that didn't exist before, is sort of masking that. And then you don't really have this true K-shaped economy right now that people are saying. And like a woman at JP Morgan, as she said, people are jumping ahead of the data. because remember, they took her words out of context, and she just said that people are jumping ahead of the data. If I had to paraphrase, because she was asked, like, are these narratives coming from? So yeah, it's just something to think about with restaurant stocks. Chipotle has come down a bit, but look at the same store sales growth, where that's trending. And some of these other restaurant stocks. I'm not really a restaurant stock kind of guy. I'm long full disclosure, we're long Toast, but that's the way we decide to play it, because we get this like really highly value added sticky product that sort of sits on top of the restaurant space, and then adds all these services that, again, you can easily monetize, and you kind of take a cut of all these restaurants. So you're taking a cut of the whole restaurant category, and then on top of that, kind of selling other services there as well. And Toast as a team, not to like pitch my own book here too much, but fantastic team there. They really understand the product. If you talk to users of Toast, which I've at least talked, everyone I know who owns a restaurant who also just so happens to use Toast, it's pretty much the same comments all the time. It's like, I can't go without it, or the product's great, etc. But restaurants, direct restaurants, the one that we thought was interesting within the community was actually Brinker. So ticker symbol EAT. I'll put them up here. So this one's interesting because they're driving a value proposition. Oh, look, and they're up 4% today. Damn. They're driving this value proposition, and I think when the club member brought them up more recently, it was literally on this recent dip, and it had this like massive move. You can see 40% move. But I no position, did not own any, for full disclosure. But what they've done with the Chili's brand is remarkable. You can see the progress in the stock price because it's reflecting the fundamentals for going back 5 years. But Chipotle, they got to figure out a new strategy, go-to-market strategy to drive home the value proposition, because the value-seeking consumer is of course true, but I think that's always true. Especially like if your burrito is now competing against the much more available, seemingly every day, access to new authentic Mexican meals. And I've talked about this to the friends over at Cashflow Kings when I was on their channel, and I brought up the point saying, for all you Uber longs out there, which I'm a prolific Uber user, Uber and DoorDash, I don't use DoorDash, but it's like the same value proposition. What it's effectively done is break down a lot of the barriers for people to, especially in the casual or the fast casual space, to get good quality meals from pretty much anywhere at a very convenient manner. So if I wanted authentic Mexican food, Chipotle is now competing with authentic Mexican restaurants that I can order with on the app, get it delivered to me, or go pick it up. But they get a lot of visibility now because I can go on the app and, for example, just search, and I can see them all together. I don't have to just go off of like just routine, where it's like, oh, I step out of the office, I go to that Chipotle all the time, blah, blah, blah. There's a little bit more introduction of variability. And I think that consumer behavior is really starting to take more and more shape. It was already a trend before. And so that bodes well for restaurants as a whole category, because it introduces a lot of new verticals to market, to get those consumers. And a lot of times, this is also true. If you talk to restaurant owners, they view Uber Eats even as a loss leader for promotional efforts. So if you never tried the product, what I learned is a lot of the you get new store visits, and people will come back because now they've discovered you through something like an Uber Eats. And so you've made that introduction. You said, hey, you've tried the food. Now you know where we are. Now you know we're here, that we exist. This happened to me recently with a burger joint that I was like, oh, I'm craving a good burger. I don't want some shitty burger. I want a good burger. And I found actually a really good burger spot through Uber Eats. And again, super anecdotal, but I was like, damn, these things do happen. They got me in through like a promotional offer, and they're not cheap burgers, but they're very good burgers, and that's what I was looking for. And then now I'll patron them when I think of a good burger. And so that's kind of like the value prop that these businesses have kind of offered to the industry. and I don't see the QSR stocks falling as some sort of sign for the consumer, because I hear it from other companies that simply the behavior is shifting. People are changing where they're spending. So there are going to be losers and there are going to be winners. Just so happens a lot of the winners might be private. And then the public side of that winner might be something like an Uber Eats or DoorDash or Toast. So changing the perspective. And of course, you're still going to have winners like Brinker and a few others, but you're going to have plenty of losers. It's a very competitive industry. Long-winded answer for a short question. But yeah, hopefully I answered the question. Ray's still getting clapped this year. Absolutely. The valuation matters, right? People say valuation doesn't matter, and then it does. And then you're cooked. Okay, so next topic. We're a little bit late on this topic, but we're supposed to be talking about healthcare. So is healthcare a good opportunity? For full disclosure, I will tell you, all the stocks mentioned in the description in the healthcare section, I am long. So full disclosure, I am long United Health. We are long Elevance. We are long Molina, and we are long Cigna. Full disclosure. All right. So now that that's out of the way, let's get to talking. So for United Health, we all know what happened there, but this one's been steady recovery since the lows. We got that flush down towards the end, peak pessimism, and then Buffett bought the stock. I don't think it was Buffett, but Buffett bought the stock. More accurately, Berkshire Hathaway took a position, and ever since the stock, sadly, has not seen $200. Actually, I think one of these days it did hit $200. I'm excited because next Friday I take possession of some shares because of some puts I sold that give me a cost basis on those new shares around like 280. So those are going to be nice. I'm happy to add to the position that way. But other than that, United, it's kind of like I'm a bit price anchored to it, but it's also I'm satisfied with the position that I have. Elevance still presents a really interesting alternative value prop as a strong number 2 player. While I don't think it's as quality as United, saying that's a bit tough because it's not like the quality difference is too large. I've posted before on X the breakdown of each business and each one's affected by the most. So for some context, Elevance and United, think of them as your bellwether stocks in the space. They are very diversified and have no insane exposure to the high risk categories, being at this point in time, which the news has already flowed through, but was Medicaid and ACA. So those two are the high risk categories that has kind of troubled the industry recently in the news. Elevance and United have lower exposure, a bit more diversified. Elevance has more exposure to ACA, I believe, than United does. Again, you can just refer to the chart I've posted on X. And Molina, being the other one, is a lot more exposed to Medicaid as a percentage of business. And then Cigna is almost all corporate. It's very little to do with any government plans. So completely different flavors, and sometimes it's confusing why one reacts. Like, for example, if Cigna reacts to news about Medicaid, it's like, why is it doing this? So but then you see like United and Elevance not react sometimes. So sometimes the market is perfectly efficient and prices everything perfectly. Sarcasm. But for the most part, it's over the long term it is. And United, I think, is still, it's a decent buy because longer term, totally see this company recovering back to normal steady state medical loss ratios in the high 80s, low or mid to high 80s, and then Elevance about the same. So that probably puts you at a steady recovery path eventually to getting towards like $600 a share. So that's like a double within a few years. And then the highest risk position in this whole sector, which I'm not long, it's probably something like an Oscar that you're going to be betting on some sort of like ACA Hail Mary happening there. But Oscar is very exposed to the ACA marketplace, while United is very much this hyper diversified player with a very underappreciated tech business inside of there with great margins, strong backlog, etc. Elevance has one too, but overall, I'd say United's tech stack is much more developed, much more interesting in my view. So if all else being equal, I would pick United over all of them, hands down. Probably with some pushback on that, with Molina being really interesting, regardless, because of its focus on a specific sector, being Medicaid, and so they're going to, let's say, be a specialized player, while United is going to be much more of a generalist. CNC I'm not mentioning, but CNC also probably a kind of more so in the pile with Molina. But in terms of like forward return, I'd probably expect a Molina and CNC. Well, I got to check what CNC is at recently, but Molina probably will outperform United, just because it's been more beaten up. And for some, yeah, there we go. So Molina, bit cheaper. It's trading at roughly around 10 times earnings. I will say this is the tinfoil hat conspiracy. So I want to clarify I have no evidence of this, and you should probably throw away what I'm about to say. So after we get that clear. So I have zero evidence for anything I'm about to say, okay, about Molina's CEO, but we're just going to entertain the idea. So something that we've talked about to the members is that Molina's CEO's compensation is dependent not on the share price reaction, but simply on earnings per share. So Molina has actually been a prolific repurchaser of their own stock. And one thing I have noticed is that throughout this drawdown, Molina has actually continued to repurchase stock. Sadly, United Health paused until next year. That's a separate comment, but Molina is still repurchasing stock. And it's not outside the realm of reason that I could have a suspicion the CEO in the last couple quarters, when they maybe were not aggressive enough in their cutting, was almost purposeful in some ways to generate a negative market reaction, to generate an opportunity or keep an opportunity to repurchase shares, because there was a point in time where Molina was clearing past $200 a share. And if your compensation package, which is quite significant, I think it equates to roughly about $1 billion in potential compensation, if the CEO can get the earnings per share to, I forget the exact number, but I think it's like 30 something dollars per share. And so if he gets it by 2027, he gets that $1 billion compensation package. So no evidence of this. I have zero evidence, and it's pure speculation. But it's odd that they were like the odd duck when it comes to their projections for this year, for how the year would end, with Elevance being right on point, and United, after the new CEO comes in, being giving us like an obviously too conservative earnings guide. But Molina came out and seemingly had this like mishap that was just a bit strange, to be honest, a bit perplexing. It could honestly just be coincidental and created an opportunity for him to more aggressively repurchase stock and then get to that threshold where he can get the high compensation. But could be coincidence. Very likely it is just coincidence, and I'm kind of reading too much into it. But that's something we were like, okay, little weird, but all things to survive, because usually when a company starts to go like, oh, we have no idea what the heck is going on, they cut back on the buybacks. That's fairly normal, but they didn't. And so that makes me think you really just do an aggressive capital return policy if you're fairly confident, or you should, if you're a responsible manager, do it if you're fairly confident where your earnings are going to be. So that's all I'll say with that. All right, great question on Oracle. We'll cover that in the Q&A. Hey, blame my TA, guys. Your answer. Okay. Did I specifically want delivery? No. I do both delivery and pickup, but I'm not real. I think the search algorithm for food, especially by category, I find it to be pretty good on Uber. And I assume the same is the case for DoorDash. Like if I'm trying to browse for different food options, I tend to find that. Sit down restaurants, I'll use other applications, but I actually am not a user of Google for searching for food places, to be honest. Actually, as of late, if I'm being honest, I haven't used Google in a very long time now. Outside of like Google products like Gmail and Google Sheets, but no, I haven't used like Google Search in a very long time. I've been using Perplexity, and for I think like 5 months now. So, and usually, actually, Perplexity has been pretty good if you ask it for like a certain set of criteria for finding restaurants near you. It's pretty good. Yeah. And so, a question on Oracle, I'll make sure to answer that in the Q&A. All right, so we got a little bit more time left. We got 7 minutes. All right, I'll kind of see if there's any answer questions up above that I accidentally skipped. I gotta look at Lululemon earnings here soon. But yeah, for some context, I mean, like there was basically every single company. Okay, it's probably on the re-Excel, I have to guess. Oh, they upped the guide. Yeah, so we're re-accelerating. All right. Anyways, that was more of a trade. Shift 4, I'll talk about that. Okay, so there's a lot of ways we can play this game. By the way, you asked for Shift 4. That's going into Q&A. So don't worry, we'll answer that. But if you were to invest all your capital in a single stock for the foreseeable future, which stock would you select? Okay, for the foreseeable future, if I want to play conservative, because you're now playing with all my money, I'm pretty comfortable, or I was really comfortable. Fortunately, like the prices are recovering with any of the healthcare stocks. My pick would have been Elevance. Again, if this is like an all-in kind of play. But I probably couldn't go. I think like I'm gonna be fun with the pick and not go like Mag 7. But within Mag 7 right now, if I'm being honest, like Amazon. But I'm not gonna pick Mag 7. But yeah, probably like a healthcare name, because we're kind of talking about a different world where you're doing all in one single stock. So you're kind of thinking what can be defensive and simultaneously offensive, and healthcare became that because of the sell-off that it had. So it can play both offense and defense simultaneously. So a recession occurs, deep recession, unemployment, doesn't matter. The answer is always doesn't matter. Does fairly well. It just matters like what you pay for it. Do you pay a premium? Do you pay a discount? Right now you're paying discounts, so probably be comfortable with that. But yeah, for the foreseeable future, yeah, probably healthcare. I mean, I don't think you'd go wrong with like a Molina still. Elevance is still okay. And then even United's still decent. You'll probably like get left in the dust, depending on where we are in the AI CapEx cycle for some of these other names. But when the cycle reverts, you'll still be, kind of sleeping well at night, is my view. That's kind of how I'm answering this question. And I think the returns are going to be above market. So Evolent Health, I have not looked at them ever. So I can't comment on them, but let me quickly look. So EVH. So this one, okay, so like revenues declining. Okay, I'm sorry. Can you guys hear Interactive Brokers? I'm sorry if it's coming through. I hear it, but it's okay. If you guys don't hear it, that's fine. Just let me know if you guys can hear it. Technical out there in the same industry. Okay, so if it's healthcare insurance, I probably wouldn't be interested in like these micro players because there is a huge. No, it's not. It provides specialty care management services in oncology, cardiology, musculoskeletal markets. And no, so like because I'm more of a generalist, I tend to stay away from like these very specific solution plays because I'm not a physician. And I don't know, you don't have to be, but I also am not someone who sits down and studies the intricacies of a particular disease. That's not me. There's people in the server, the community that do that. And if anything, I just crush on them if I have any questions on these things. But I can understand insurance and risk arbitrage, which at the end of the day, that's insurance. That I can understand. I can understand more systematically, statistically, the risk profile of a population. I can't, if I'm being honest, understand. This particular solution of way of treating this disease is the best way, and they came up with it, and they have a patent on. I can't, get involved with that. Thanks to ChatGPT. Yeah. Okay. Perhaps. Yeah. Okay, so if you guys don't hear it, then we're good. I'll continue. All right. So, what do you think about call center business? Biggest player? Oh yeah, I've been asked about this. I haven't looked into them, but I might. It might be interesting if there's not too levered. And let me actually player teleperformance. We're gonna put a star in this. I'll look at this right after we get through this next conversation. But because I haven't looked at if they're highly levered or not. But if they are, I mean, I probably wouldn't go near it. Because call centers would probably still exist in some capacity, but definitely scary industry to be in, given that's actually one of the best ways AI right now is able to be implemented and disrupt current industry. All right, so we're on to the final organized topic, and that's going to be on private equity narrative getting faded for now, and the negative market returns prediction. So I had a tweet today, and that was on this one. So Compound 248, which I think he agrees with me, by the way. I saw he retweeted my comment to him, and this is the tweet in question or the conversation in question, because this is repeated, and I'm kind of bullying one of my investments being Apollo. So for full disclosure, we are long Apollo. But Apollo has a reason to say this, and this has been repeated again and again and again and again. The expected return in public equities over the coming years. The historic relationship between the S&P 500 forward PE ratio and subsequent 10-year annualized return shows that investors should expect to get zero in return over the S&P 500 over the coming decade. See the chart below. Okay, so the reason why this argument is so, like, if it's correct, it's for a different reason, funny enough, and not for the argument they're making, because the argument they're making is way too simplistic. In reality, the context missing is constituency. So I've brought this up before, and if this is the first time you're hearing this, welcome. I'll try to equip you with this argument so you can go out there in the world and make the same argument and kind of shoo the people who say this, because it's too simplistic. This is a great argument if the constituency was the same in terms of percent allocation over all time. Because I'll say this for a moment, Microsoft should never trade at the same multiple, normalized multiple, as something like ExxonMobil, or at least the Microsoft of today shouldn't be trading at that, given that Microsoft still has close to 20% growth rate, even at its size. This argument I've heard in different ways, in different organized fashions for 5 or 6 years now. Either something rhyming with concentration risk, et cetera, et cetera. And talking about the multiple of the index sort of being a problem in and of itself. And that really comes from, and I get it, right? You look at historical trends, and then you draw a conclusion from the historical trend, and you say this is like what's going to happen. History is going to repeat, but that's ignoring that history is different at all times, and then so you're not going to be as precise or accurate as you might think you're going to be. So back in the day, the top constituencies of the S&P 500, it had a lot more concentration in manufacturing, it had a lot more concentration, so cyclicals, had a lot more concentration in the commodities, right? So oil, largest company in the world at one point, or in the United States, used to be ExxonMobil, among the largest companies in the United States. It's still a large company, but it's now overshadowed by Microsoft, Nvidia, Apple, Amazon, Google, and the like, and Meta. And so the difference, of course, is like these are more stable, steady state businesses with immense ability to grow in terms of scale. And so when you produce a product, let's say software, you produce the software, and the sky's the limit how many people can adopt the product. For oil, well, you got to dig more oil. You got to spend more to get more to give out more. So there's like a scaling issue with oil inherently, and also you don't choose the price; the market chooses the price for you. So that's also problematic, right? So inherently, these are fundamentally different businesses. And then conversely, or alternative to that, the constituency of the S&P 500 used to be also far more concentrated in financials. Financials also have these cycles, right, that go through them. So in the insurance industry, we have the market cycle: hard market, soft market, hard market, soft market, hard market, soft market, on and on and on. And in that cycle, we assign a, let's say, multiple to that of uncertainty, because you don't know where you are in the cycle. So a lot of investors get pulled in when we're in that good part of the cycle, and then they are surprised with the poor returns when they're in the bad part of the cycle, because they bought in the wrong part of the cycle. So all this to be said is like the constituency matters, and Apollo saying this, I get it why they're saying this, because it's advertising. So keep doing it, Apollo. Keep convincing more people to this is the case. But for my small audience, that will not affect Apollo sales. So it will not affect my forward returns on the investment, because I think they are going to do well. Yes, I don't think what's being highlighted here is the problem per se. There are other problems that we should probably be focusing on. And it really comes down to, is the forward E correct or incorrect for these companies? That's really the debate. So I respect more the debate being had around that than around the aggregate multiple of the index being too high. So yeah, that's where we'll leave off that point, and we'll come back to private equity. So private equity earlier this year, it's having a very rapid recovery, and I'll put up actually we'll put up the 6 month to kind of illustrate more recently. So we had this nice little drop down in April where you got a nice opportunity to pick up Apollo, KKR, Blackstone less so, but a lot of these high quality names that are gobbling up the asset management space. I'm just remember, if you ask me a question on a stock, I'm starring them. So I'm not going to ignore you, Jonathan, but I'm starring. So I got 9 stars so far. All right, but let me actually pull this up. So just for comedic relief, I posted this back in October 17. Me buying the shares you panic sold off of Backwater Regional Shitco Bank having a problem. So to illustrate, like, I love the internet because it's like timestamping, it's documented. And so if you haven't watched this meme, it's kind of funny. I think so myself, what being retarded feels like. 2 ways of interpreting it. I could be talking about the person selling it, and then which I'm making a light gesture of saying, haha, you're retarded. Or I'm talking about myself. It's up for interpretation. The secret is I'm talking about myself. So, oh, that's a great question on PayPal. We're going to talk about that. Shark Ninja, talk about that. Okay. But yeah, so I think on the timing aspect, it was pretty good. October 17. What was no. not the exact bottom, but had this like little fiasco here. So pretty good in terms of timing. Also, if you guys don't know, this has been my pinned tweet for, well, since I posted it. So, but yes, that was a bullish signal the whole time. And now it's kind of gotten more normalized, but yes, contrarian. Oh, I have to share this. That's been my pinned tweet since I posted it. All right, coming back to Apollo. So the private equity narrative, and one of the people I don't like, I think they're really silly, to be polite. And they blocked me, so that's a good thing. But I still find entertainment in screenshotting their posts because they're very silly. And well, I won't even say the person's by name, but if you know, you know. And it's a person who went on the Steve Eisman podcast. Who Steve Eisman, great guy, has, you know, varying amounts of quality guests. So some are very high quality, some are very low quality. And then when they're really low quality, they're like really low quality. So this one was a very low quality guest who basically made a lot of nonsensical arguments, you know, made claims to having accounting experience, but when they spoke about accounting, it didn't really come across as that. But a lot of the arguments for, like, you know, the death of private equity really stemmed from the private credit bubble that we saw. And it's like kind of hilarious. They cut the cockroaches in the sense come out of the woodwork when there's a lot of panic. And so there's like, oh my gosh, the stocks are down. So stock price drives narrative. But then I broke it down. So it's not like it was hard to see. Everyone could have seen it. I think most of the people who follow this space saw that these points, and the points being the following. So when the tricolor fiasco occurred, they're blaming private equity and private credit, but private credit, the ones who are like the champions of private credit, being Apollo, were short the debt. They were short that debt. And if you look at the list of entities involved being long the debt, well, a lot of banks were involved there. So not necessarily private credit names. Some BDCs, some CLOs, right? We're definitely in that list. But the ones you think about when you think about private credit were actually short. You know, Brookfield through Oaktree and Apollo. They were both short the debt. Fascinating, isn't it not? And so that was like one thing where it's like, my gosh, you know, these guys, they not only are the goats when it comes to private credit, but when you see this whole fiasco boil over, they're the ones actually making money on the way down as well. Like, how can you not appreciate that? And we also kind of looked at some companies like iRobot, where you had Carlyle Group do this like fascinating transaction, and you kind of start to think about that and appreciate. Well, first, like the talent pool at these firms is really high. They take very high talented individuals from various firms, and you see that in some of the deals that they strike. So what Carlyle Group did that was really fascinating. Some of you might like this or appreciate it. There's a company called iRobot. They're basically dead. They're not paying their suppliers, and they're only getting a bid right now because retail is very retarded. Regarded. Apologize. Pardon my French. And they're buying up the stock because it's got robot in the name. And so the rally started when the White House talked about this initiatives for the following year with robotics, but they are a vacuum cleaner company that can't pay their suppliers. So what Carlyle Group did, because they had some of the debt, is the suppliers had already given inventory to iRobot. They're not getting that inventory back, but they want the inventory back. So Carlyle Group got them to buy the debt off of them in exchange for now them having claim over the inventory. This is genius, right? As far as getting your hands clean of this bad investment. So you can't just you can just sit back and say like, damn, you guys are good. Like even when we were like, yeah, you're cooked now. you're cornered. You can't get out. No, they find a way. They're very creative individuals. So they're magicians in finance. Now that doesn't mean they made out like bandits or they profited, but they got out of a lot of heartache. So, but yeah, iRobot. If you saw this or you know about this, you know, it's a mess. It's a mess. Okay. Oh man, guys are coming out with great questions. Oh my gosh. All right. Some of these questions are connected, but great questions all the same. All right. So to wrap up on private equity, because I want to get to these questions. I have 14 questions now on the back burner. I think that private equity still presents a relatively interesting opportunity, not as interesting as before when you had all these like crazy narratives sort of spilling over. And I think when we broke down those narratives, they did not make too much sense. Instinctually, there's a part of me that, would also say like, yeah, that kind of makes sense. Like private credit, shadow banking, scary word. Shadows and banking, those two words don't go together. Uh, you know, 2008 rings a bell. Big Short 2.0, and that's a great second guest, follow-on guest that Steve Eisman had, which was more specialized guest on private equity. Gave a lot more of a I would say full perspective. But he had one guest on that was just like, oh, they say they have an accounting background, but when they speak, it's like there's no accounting background here. It's just blah 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 blah. I want a movie about myself. Blah 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 blah. Oh my gosh. All right. So now I'm going to get on to questions. So topics are done. Once more reminder, shameless plug. I am sponsored by myself. So link in the description below for access to the Capital Mindset Club if you want to see my portfolio and the like. And then below that, you'll see Physical.ai, a sponsor of a product I actually use, actually like. You get I believe, a discount on that product as well. Helps support me now that I'm doing this full time. And when you go below that, I also have a friend of the channel that I'm sponsoring as well, or he's sponsoring me. If you're in the United States and you need help doing your taxes, you guys know Strongman Personal Finance. So you get a free consultation. You can click the first link is a presentation that gets you the gist of what the service is all about, everything you need. And then the link below that is to book the free consultation. So if you guys use that, let him know that I sent you. And then that also helps me out on the channel. Okay, that being said, let's get back to the questions. So, all right, starting us off, are you still bullish with Evolution AB? I am. I just think for the time being, there's no catalyst that really drives it up until you see clarity with Asia, or you see some improvements in Europe. You can have the Asia business be stagnant or being problematic for a while. But if you see improvements in Europe, I think that's enough to jolt up the stock again. And really investing or stock price movement is all about, identifying identifiable catalysts. There has to be, think of it this way. If I had to break it down in the dumbest way possible, short-term price action. And if you're trying to optimize entries and exits, let's put TA to the side for a moment, but just kind of on the fundamental basis, we try to think of catalysts. Why would someone suddenly pay me more than before? And that's not part of your question, but I'm trying to give you a holistic view on it. So right now, there's no catalyst on Evolution. Right now, there's only, let's say, muddy water. There's not a lot of clarity. So it's a troubled stock. It's a broken stock, not necessarily a broken company. When I look at the business itself, I think that they're going to be lapping some comps here. So next year could actually look really good. And so starting a position here into next year, and really it's all about, opportunity cost at this point. Like, do you have other opportunities at this moment that are better than an Evolution? That's like kind of the question you got to ask yourself. And never be afraid. And I think that's something people make a mistake on with investing, is like being afraid to sell a position, and you can always come back to it, right? If you want to, don't be married to a stock, is what I'm getting at. But finalize your questions. I get to the next one. Yes, I am. But I am also saying in the near term, there's no catalyst. And Kenneth Dart buying more shares is not necessarily a catalyst. He doesn't have the same clout as like Buffett. Buffett actually buying a stock acts as a catalyst, believe it or not. I mean, actually, believe it or not, you guys all believe that. All right. So any thoughts on Mercado Libre? Currently, my number one conviction: 30x EV to EBIT, 40% growth, massive runway. Love this company. We love this company. So, like I said, full disclosure, we are long Mercado Libre. So this is a company that I think, and I keep saying this, I am glad to see it when other people go to Latin America and they discover it for themselves. But I keep trying to tell people that haven't been to Latin America. If you guys don't know, I am a Latin American born person. But I know I don't look it. And so for those of you who are new to the channel and are like, also, we're from a country down there, you're like, no way. And I know, yeah. But Mercado Libre is basically the American or Western standard of logistics, customer service, etc., brought to Latin America. And believe it or not, in terms of in the financial space and in the retail space, there was a lot missing there, a lot of demand that needed to be fulfilled. Mercado Libre is doing that in spades. And that's why they're attacking all these different verticals. You need to appreciate it. Just take my word for it. There is a massive, massive hole in supply versus demand for financial services in Latin America. Massive runway. And in terms of the retail, like when Amazon and Mercado Libre, they're probably going to be the most dominant two players, if I was to predict. And there's room for both of them, just because. And Mercado Libre's strategy is really interesting because it's more of about an integration. So take their pharmacy business as an example. They take the local pharmacies and they plug them into their network. So you're part of the Mercado Libre system. So they make money from the fulfillment and the transaction volume, et cetera, all of that. And so they're not just building a new pharmacy and trying to outcompete the local small pharmacy and kill them. They're trying to integrate them into their network. So when you're fulfilling your pharmacy's orders or prescriptions, for example, you're going to be utilizing a local pharmacist or a local pharmacy. And so it's like a win-win-win all the way through. So Mercado Libre, exceptional management team. There's an interview. If you speak Spanish, or I think you can just use closed captions, and the translation is fine enough. But there's a great interview with the new upcoming CEO that I think you guys should all go listen to. Just look up Mercado Libre CEO interview. It's in Spanish, but again, if you speak Spanish, it's great. If you don't, closed caption should work, and gives you an idea of like the philosophy, the mindset of the people over at Mercado Libre. And like I said, what people have a hard time understanding and appreciating is just like how much is there for fulfilling this need in all of Latin America. And generally speaking, I'm like I'm not like hyper bullish Latin American economies, but I'm generally more bullish than not on global economies, and that humanity is going to move up and to the right, economically speaking. And so Latin America will move up and to the right at presumably a little bit faster pace than the United States. You just have to worry about, of course, political risk, because naturally, more unstable political culture, political climate in Latin America. So you got to appreciate that. But I think the guys over at Mercado Libre really know how to navigate that by now. Okay. I'm coming back just to see if there's any more questions. I have to star. Oh, a question on Dave. Oh, Dave went up today, so I unstar your question. Okay. Okay. Any takes on the SpaceX IPO, OpenAI? All right. So my fun prediction on the AI top, I said this a few live streams ago, but I'll say it again here because we're still far out from it. Relative AI top is OpenAI IPO. So if I think everyone's too early when they're saying it now. I think it's coming next year when OpenAI does their IPO. We'll see. And I think the valuations could get pretty crazy. But we'll see. And it's just a fun prediction. I'm not really going to act on it. There's no promise on me acting on it. I could be, like I said, full disclosure, I could be sold out of everything tomorrow after I turn off this live stream. I could sell everything. I could also go hyper long leverage. I don't have to disclose that, right? But as far as my current opinions right now, as we're recording, that's a fun opinion. And I'll tell you when it's a serious versus a fun. That's a fun opinion I have. Is like, that's probably the top. It's kind of like that. Casual prediction. But thoughts on that? Great that we're seeing more companies go public. Sad that they're going public at such a late stage. But whatever. Okay, another Q&A topic for later. Any interest in the e-commerce titans besides Meli and Amazon? See Coupang. See, not so much. Okay, I'll give you a. So Mercado Libre was actually one of my earlier investments. And back in the day, there was this rivalry between C and the Meli guys. So you'd go on forums and you'd see like the people that were long and knew about Mercado Libre, like the Mercado Libre cult, right? This was like way before COVID. Were always like at this like similar to like the joking rivalry I'm trying to stir up, or it kind of exists between the Toast shareholders and Shift4 shareholders, where it's more so the Shift4 shareholders, they diss on Toast, and the Toast shareholders don't diss on them because, just to throw some shade for fun. Okay, calm down. The Toast shareholders, we just don't care about, what the opinions of the sheep are. That's a joke. Shift4 shareholders, calm down. I know this is like on X, and so there's a lot of Shift4 shareholders and longs on X. Please calm down. It was a joke. But back in the day, we're talking 2017, 2016, 2015, like there was this like heated debate between C shareholders and Meli share all the way through. I'm like, oh yeah, C's gonna eat your lunch, blah, blah, blah. Oh, Meli's no. And so back in those days, like one of the reasons I didn't like C, I was a Meli guy, was Meli was building everything internally. And so that means that they were growing slower in some respect, which they were still growing really fast, by the way, but they weren't experiencing in some years this hyper growth that C Limited was getting. And C was using a lot more third party infrastructure. And I wasn't particularly a fan of that. I thought Meli had the better culture, but that's just a comment on them. Coupang, conversely, I think that's a high quality player. The only problem is they're limited in scope of their geography. So they are expanding outside of South Korea, but and they're getting into cloud, which is easier said than done. But I think they could do it. I think it's possible. So I probably put Coupang on that. Jumia, don't even talk to me about Jumia. I don't even want to know about them. But it's pretty much Mercado Libre, Amazon, and Coupang for me. If there wasn't the VIE issue with the Chinese stocks, there would be Chinese names that I would throw on there. But because of my whole fiasco of like, how I could not bring myself to buying an asset that I cannot own, I wouldn't even consider them for myself. But there's definitely some names interesting there. If you could own the assets, would be interesting. But because you can't own the assets, it's not interesting. Okay, thoughts on Oracle? Is it buy anywhere near this price? Is something to steer clear of? Okay, so this is a great question, but my thoughts generally on the excess capacity players is that there's a part of me that thinks that we are being a little bit overly negative towards them, depending on what questions people are asking. So this is not as much true for Oracle as it is for the neo clouds, but if people care about the long-term profitability of these entities, then I'd be horrified to own a neo cloud, because I don't think the profitability is going to be there. The neo clouds, think of CoreWeave, IREN, Nebius, etc. All these like FinTwit. Well, CoreWeave's not really a FinTwit favorite, but the other two are. And so when I was kind of working throughout the numbers, I kind of came to a terminal net margin rate in the like mid to high single digits. Because keep in mind, they like to point out that their adjusted EBITDA margins, they keep showing that, but most of the expenses were really coming down into that depreciation amortization category. So when you eliminate that, of course, it's going to look like really high when you're eliminating your main expense. But I'm talking about net margins. So if people are asking the question like, what will the net margins be? I'd be terrified to own them, because I would think there's quite a bit of downside implied. But if no one's asking that, and the real fear right now is about revenue growth, there's going to be tons. I think there's going to be tons. And so as a trade, you buy that. On the question for Oracle, they are, what I saw is like they are going to be spending or they're going to be using a little bit less debt than they previously thought. But the backlog still seems healthy, and it really comes down to where do you think this like spend or appetite for spend from OpenAI is it going to continue? And I think it's going to be tied actually to a re-accel we might see in OpenAI's ChatGPT. So if we see OpenAI reaccelerate users, which actually I think one of the folks who actually has the data insinuated that they're already seeing that, but not verbally saying because that's not public information yet, but basically implying as such, then that could be a pretty positive catalyst. And we just saw like basically this flush out in Oracle, where now you probably go long the stock and you'll probably see maybe even a new high, maybe not the new all-time high, but new relative high for the past 3 months or 2 months in the next year. Preferably, I mean, I still like the other hyperscalers that I'm involved in, and I understand their place in all this a lot more than I do something like an Oracle, which is more excess capacity. But I think Oracle's sentiment is going to be tied to like OpenAI, and so like if OpenAI sentiment improves, right? Because everyone's talking about code red, and saying like OpenAI is done for, which I think is too premature. Then there you go. But speaking of which, I think they just released 5.2 or whatever. I think I have access to it now, actually. Yeah, let me see. Yeah, 5.2 right there. Yep. Okay. Oh, okay, great question on MSCI. I'm coming back to the comments section to star anything, and then I go back to the star comments. All right, great question, Lucas. Yeah, 2 great questions. I'll answer both of them. I'm at 18. Let me unstar the ones I've already answered, so I can declutter my star space. Oh, I didn't answer the second question. Is it a buy anywhere near this price? So direct answer, yes, depending on what we talked about, like how you're thinking about this. I don't think the market cares that much about the profitability question right now. And that's more so me opining on the neo clouds. Oracle is profitable, but I think maybe the market's more caring about revenue growth and realizing the performance obligations. So the realized performance obligations RPO KPI. So if that's the case, just watch out for that. And I'd probably bet. Again, my fun prediction is like here until the end of next year is like that's my fun prediction on the top. So if I go off of that, Oracle's probably a buy here on a recovery. We'll see how that ages though. You can come back and make fun of me. Oh, I already answered this. Yep, I accidentally started that. Already answered that. Okay, Shift 4. I think they're cheap. I prefer Toast. I think Toast has a bit more of a. I like Toast's management team. I like Toast's product suite a little bit more, but I can't say or claim that Shift 4 is not cheap. I think Toast deserves more love from the FinTwit crowd because FinTwit gravitates towards 4. I see very few people on FinTwit talking about Toast, and as a Toast long, I get sad that it feels all lonely on my side of the park, and then I look at the guys on the other side of the park all having a good time together. So I just want to steal some of you and bring you over to the Toast side of the park. Kind of like a losers club dilemma. But losers club, we defeat the scary clown. So if you think of it that way, you might as well join the losers club. Well, losers club because we win, right? Because Toast is winning, but something we don't care about the opinion of the sheep. Something. Oh, calm down. It's a joke. Okay, so I'll skip over this one for now because that's going to take me a little more time to answer. So before year end, I mean, I've been liking Amazon this whole year, adding to it selectively on like these narrative formations about retail being dead and cloud being dead. It's still shocking to me that, well, it's not shocking to me. Really, after a while, you kind of get into like this whatever. Especially if it's not a new position for you, and it's kind of something like it becomes a legacy position. It's very easy to hold through and just sort of just like add to it as time goes on. But I'm really positive on Amazon. I don't know what it's going to do, for the next 15, 30 days. I think it's going to be more valuable in the future. I think ads is going to do better. Cloud's going to do better. Cloud's going to continue to re-excel. Retail is going to continue to be strong. It's going to fuel ads, yada, yada, yada. Are you still positive on PayPal? Some retail investors. I'm still positive on PayPal. I think it's just taking more time to realize the story. So the turnaround's there. It's happening. I am taking note that retail is folding on PayPal. That is super interesting. We had people going from 100% PayPal to 15% PayPal. That's super awesome. And I'm seeing capitulation across the board. So that tends to, be the prerequisite for something healthy, something nice, something very spicy, so to speak. But yeah, PayPal, as long as, and they got downgraded today on B of A, at B of A, because of concerns about the legacy payments and legacy product. The legacy product, yeah, it's been troubled for growth. Braintree, not so much. And Braintree's margins are going to continue to probably improve. So Braintree just has to take more mind share from investors. And the legacy payment product, I mean, of course, I don't really expect much growth, nor do I ever expect much growth from it. I just don't expect decay. I think for the thesis to play out on a PayPal, you need a growth catalyst. So you need something to grow, and they are growing totally, in line with something like actually what Adobe is growing at. You're just getting it at a cheaper valuation as well, but totally different businesses, payment platform versus software. But apples to apples on just like earnings, dollar earned here, dollar earned there. It's roughly the same growth rate, and similar in terms of like praise I'll give them on like no levered buyback. So the buyback is very sustainable, or relatively sustainable. They're not levering up like crazy. We're putting the company in jeopardy for both businesses. So really it's a question of, and this is the question for both of them, it's like how stable is going to be the business and is going to continue to grow. So for PayPal, it's how stable will the branded checkout be? And then as in it's going to cash cow grow at, mid to high single digits, or even mid to low single digits, but not decay. And then you have the other businesses, Venmo kind of picks up, and then Braintree picks up. Then that drives your returns. That's in Shark Ninja stock. I accidentally unstarred your comment. So Shark Ninja, the guys over there are crazy good. So they kicked Roomba's ass, and they always come out with really innovative products. I missed that one. That was when I was thinking about buying on IPO, and I completely fumbled. But at the same time, it's like it's not really my kind of company that I could probably hold for a very long time. I don't find that attraction to the business. And I know I shouldn't think of it that way, but and yes, sexual attraction to a company, absolutely. I didn't stutter. I meant to say that. Okay, I have not accounted for any predictions, or I have not encountered any predictions of impending crisis all this time from your end. Do you consistently maintain a bullish outlook, or do you anticipate a market correction in the near future? Okay, so if you go back to my content back in late 2021, early 2022, I did a lot of videos. I'm more proud of the ones in the late 2021 ones because I was a little bit before. But the liquidity crunch I talked about that a lot. So I'm not a perma bull, but I am someone who I think takes a practical view on like being bullish, being bearish. There's I took a cautious stance in February of 2025 and had a call out in the what we call the weekly call. The title of it was literally, and I posted about it on X too. But the title of it was here. You know what? We'll just get it. Just show I'm not a perma bull. I know that's not what you're implying, but I'm just trying to also illustrate that. We'll go to the weekly call archive. Let's scroll all the way back to February. Oh, went too far. November, December, January, February. Okay. Oh, let me just take a screenshot. It's just easier to share. And I'll just send this to post it in here. And then I'll just put it into the web. All right, cool. So easier for me to just share it this way than sharing an application, I guess, because it was being a little mean. So yeah, so it's not like I'm like, oh yeah, it's always great. But then, April happened. We had that massive sell-off, and it was like the reverse. I felt like I was fighting people to be bullish, and people were just freaking nuts. And honestly, like the members who are in chat can attest to this. It felt like I could threaten to shoot someone's kneecaps, metaphorically, and I couldn't get them to buy. I had folks telling me they want to time the bottoms. I was like, what happened to you guys? You guys used to never be this way. You're breaking my heart. Not everyone was like that. But yeah, so I know you're not saying that, but just want to clarify, I'm not a perma bull. I think when you're perma bullish, it defeats your let's say quality of opinion, because it's like, oh, you're just always bullish, and therefore you're going to be right most of the time, or there's a bias for you to be right. Absolutely. But yeah, now, right now, I see the bearish narratives as not really having much grounding. So the four narratives that we talked about and kind of tried to attack, all four, was consumer is dead. I disagree. Consumer is actually pretty good. I will change my mind if I see facts that conflict against this. It's just that I can't find them. I find distorted facts, absolutely, but not something that supports. I see a lot of headlines that support that idea, but I don't see a lot of companies supporting that idea. And then the second one being, of course, unemployment. I think unemployment, it's like, okay, it could weaken from here, but it was like at a really strong point before, right? So it's like, okay, nuance is needed there. And also, we saw with the October, the last data report, that kind of people didn't really, they glossed over it. We saw some positive, some very positive, alongside with some negative. So most people elected to just look at the negative. And then we have private equity or private credit bubble, whatever, and then the AI one, which is also whatever. Those I think are tired narratives, but they are very persistent. And so we try to break down all of those. Okay, but the part of your question, do you consistently maintain a bullish outlook, or do you anticipate a market correction in the near future? So on that part, I'm structurally bullish right now. Corrections can happen, like we just saw one just now, but I'm structurally bullish in the end of year. Someone asked about the Santa Claus rally, so these two are connected, and I think so. But the Santa Claus rally typically happens after Christmas, so right now we're in that predictably low volume phase. So right now there's no volume. You might look at some of your favorite stocks; they might fall suddenly, and there's no volume. Just don't worry, perfectly normal. Just Santa Claus rally. If it happens, it's going to happen after Christmas. Okay, so if you had a 5% cash and you had to add to your favorite opportunity for getting allocation percentage, what are you adding to? I think because of today, Affirm was a good ad. Affirm was a good ad because it plays perfectly into the consumer is not dead narrative. Structurally long tailwinds ahead of it in the change that's happening in consumer credit. It's a very misunderstood asset. That's only going to have to just prove people wrong. Great management team. Can't really say anything more about how much I like about the company. And by the way, like that's a great example of a company I used to be uneducatedly bearish on. And goes to show you when you have a community of professionals from all different walks of life, if you talk to them and they talk to you, and then you listen to them explain things, and you try to learn, your mind should change on things. And so my mind was changed as I was educated on the Affirm product. I've shared this story in the past before. But yeah, if you go back, I have videos. I'm never deleting videos, but I have videos of me talking poo-poo about Affirm, and yet I'm long Affirm. Now, what I believed back then, and I was right for the wrong reasons. So I was right in the sense that the stock price went down, but I was right for the wrong reasons because a lot of what I had stated as far as like the prescription of what was wrong with Affirm was wrong. But the stock price went down because the valuation was crazy. Simple as that. So yeah, that's probably my answer for today. What do you talk about CSU? Any opinions on Workday? So Constellation, I like them a lot. That's another one. That's a middle finger to the AI will kill software narrative. I like Topicus, which is more concentrated in the European critical industry value add sectors. And Lumine's this interesting alternative strategy. But Constellation, you have a few of the business units that are a bit more exposed truly to AI disruption, but not everything is exposed to disruption. I think Constellation will do really well here. Workday, man, these companies, it's just like they should be way more profitable than they are, but all that SBC, man, I hate that SBC. I'm an SBC hater for sure. It's like these companies try to make themselves look way more cash flow positive. So I'm okay on Workday. It's like, yeah, it's good. It's fine. It's not negative. All right. So wouldn't the catalyst for buybacks be for Evo, kind of like BTI style? Yeah, but BTI fumbled the bag hard on the buybacks. But no, yeah, like Evo is actually at least doing 50% of capital distribution at the moment in the form of buybacks. So it's fine. No, the catalyst for Evo really has to come down because we've seen buyback stories that they act like coiled springs, to be very clear. But when you're buying back a stock and it's not like a huge percentage of the company, I think if Evo did 100% of their capital distributions as a buyback, then that could actually be very stimulative. I think that would be almost hard to ignore. But the fact that they're not is unfortunate because I think the buyback's just not enough. So it's by itself, it's not a catalyst. I think you just have to see fundamental business improvements in either Asia or Europe. I think more violently it would react in Asia improvement, but Europe improvement could also be very good to kind of start to push the business up. Remember with the Asia business, if you actually remove the Asia business entirely, it's trading at 18 times earnings. For some perspective, it's trading at 10 times earnings if you include the Asia business. But if you assign zero value to the Asia business, it's trading at 18 times earnings. Okay, MSCI opinion. I like MSCI a lot. Here, I'll actually share. This is actually, so I have, if in Capital Mindset, you have, of course, the holding co, which is a portfolio of size of about 2.2 to 2.3 million. And that's the main portfolio that I've updated since creating Capital Mindset. Then I've recently developed a new portfolio strategy. And I'm updating this one as well. And I'm thinking actually about doing a whole video series. And I've hinted at doing this when I quote unquote soft retire. And now that, we got the fund going, et cetera, the soft retirements happen. This strategy is more of a lower beta, quality based strategy where it's going to focus on still generating a respectable rate of return, but it's going to be an account from which I draw from, and I'll usually carry a very regular high cash balance. And so from this account, I generate income, I manufacture income. And so this was actually created because of popular requests from folks from CM that are, maybe closer to retirement or in retirement. And it's like, I want more of a research or content based off of this. And I was like, well, I also have a need for it. So let me explore this when we get to that time period. And so we're basically there. So the reason why I'm saying that is that's actually one of the holdings in there. I'll actually, I'll share this so you guys we can take a look at it. So I was already just actually organizing this. So I just so happened to have this up. And I was like, okay, I'll talk about MSCI because you guys can see MSCI is actually one of the positions. So it's kind of like every business that makes up this portfolio is going to be higher quality. One that I think is still decent value relative to what they are. So like Visa, MasterCard recently presented really compelling opportunities along with the MSCI. So you can kind of see by the allocations which ones I thought were really good, compelling buys recently. This is not, and I'm going to be upfront, in the main capital markets portfolio, there is nothing except for one position here that is really of overlap, and that is Apollo. So I'll just tell you upfront. Everything else is unique to this portfolio. Netflix I hold only in my personal accounts, not in the holding company, which is representative of all the investments I made since starting the Capital Mindset Discord. So Netflix, that's the only overlap there. But I recently bought Netflix, etc. And I was going to do a whole video series of every single company in this and the one ETF, which is an interesting ETF. But every single company going from smallest to largest, or maybe largest to smallest. I haven't decided. And so that's going to be like the way to organize my video creations when I start making more videos. So I already have my list. It's all of these companies. So yeah, just wanted to share that. You have any question on this? I can always come back to it, but for now, we'll put that to the side. Okay, so I've done with this one. I'm on this one. Boring industrial stock part of the portfolio. I think Couche-Tard, secure waste. Well, no. Okay, so that I think it has a place depending on where you're at. So right now they've probably not done very well, but they will have their day in the sun. So like I can say on Couche-Tard, they and secure waste. Oh, secure waste, great business too. They'll have their day in the sun. So secure waste, that one's just having a lull, in my opinion. And then, so I have no position in any of these. So not like biased in saying this, but and Couche-Tard, they just recently divorced from 7-Eleven. Buybacks are now the name of the game there, similar to like a Musa or Murphy's. So I think you just sit on that. Great management team. They'll figure out how to compound your capital. Okay. Now we're going back here. Am I worried about the debt in Shift4? Yeah, I saw as that is the one bear case on Shift4. Like I said, I'm a toast guy. Full disclosure, I'm a toast guy, so I'm no fight in that game. And that could be the reason why Shift4 is cheap. My issue with Shift4 is when one of the members who's invested in Shift4 explained to me the ownership structure, I was a bit turned off by the complexity. Plus, I'm more familiar and more in love with the tech stack over at Toast. That's all I'll say there. If you have to make a prediction for the next year, which sectors will perform better? What do you say? AI not accepted. All right, cool. AI not accepted. The thing is, though, from the time period I made this bet already with someone, I think healthcare does really well. And I still think industrial stocks do well. Trucking could also do well. Trucking could also do well. Damn, I'm in between those three. Trucking just started, or it seemingly just started. Another one that could do well, but the thing is, housing is too broad. There's like housing stocks I would not be bullish on. Anything involved with new housing construction, but things involving existing home sales probably do really well. But yeah, I'd probably go with one of those three: healthcare, industrials, but like industrials that are focused on, reshoring and infra, that kind of stuff, which has still done well this year, but I think it continues to do well. You said no AI accepted, so, and technically a little bit of that infra is AI really, but hey. Next earnings season is going to be wild. Too many people believe anecdotes over data. For which anecdotes over data? Because I think I know what you're referring to, but why hasn't GNRC gooned yet? Because people are still tying GNRC to like weather. So without the weather fiasco, this narrative around Generac is just going to be weak. Okay, what price do you feel attracted to increase your position? Same question for Amazon. Amazon, I recently did when I had that sell off back down to like to 200 teens. TSM, I averaged up on the position, and it's like we're long it in the fund, so I'll say it that way, and it's not too far off the current price. It's still got legs in it for at least a while longer. Evo's management has been so frustrating. I wouldn't be opposed to levered buybacks for Evo, to be honest. They don't even need to do that. I just need the European investor base needs to just push for and not have this like dividend supremacy mindset. You want ideally a hyper flexible capital return policy. The ideal, the perfect capital return policy, and no one can change my mind on this, this is fact, is flexibility. What I mean by that is when you're very cheap, like you are now, and if you have a good management team that can identify that, you want to buy back as much as you can. It's more tax efficient, yields better, greater returns over the longer term. There's already studies that have been publicized showing that stocks that tend to do more buybacks tend to actually have an actual measurable outsized performance than stocks that do when adjusting for factors like decay in the business or growth in the business. Normalizing for that, it's a superior form of capital return. When the stock gets quote unquote expensive, measured as you can define it as some sort of like earnings yield, and saying any incremental repurchase in shares equals a much lower return on investment because the earnings yield is much lower and the forward growth maybe is not the ideal. So then you pile up cash and then you just focus on dividends. If Evo did that, it would be perfect. Right now, it's cheap enough. And if the company wants to eat its own lunch, eat its own cooking, and you're telling us, oh yeah, we have a lot of growth ahead of us. Why are you wasting any time with a dividend? If you're fulfilling all your CapEx needs and you have all this extra cash and you're saying that about the stock, I would get frustrated, absolutely, if you're paying a dividend at all. I would say just do a buyback and then pay me a dividend when the stock price re-rates. That's when you can pay me a dividend. But until then, you do not stop doing any buybacks. You do only buybacks. Don't worry about what the market's doing. The market, there's never been a last man standing case study. So if the market keeps lowering the share price, but the business is still growing or maintaining stable, everything will take care of itself. But European companies are very averse to that. We're lucky they're even doing a buyback, to be honest. Love Netflix, the company. Been a believer in Netflix since all the haters were haters. Defending Netflix since 2022, literally. This acquisition makes a lot of sense. It's not going to be a problem for them to swallow it up. And yeah, I like the company a lot. I've been recently buying some. So, oh yeah, Big Pharma Shill always wants to know about NVIDIA. So I gotta always answer his questions on NVIDIA. He's very, very interested in NVIDIA. But yeah, thoughts on NVIDIA? I think they do AI stuff, which might be big. Looks cheap here. Um, yeah, they kind of do AI stuff, and yeah, probably probably gonna do big things. Yeah, I think AI is gonna be big. Big Farmer Show. He's obviously joking. Thoughts on Broadcom's earnings? Um, it's more of the same, honestly. But valuation is my main concern. Valuation doesn't matter. I get it until it does. And so the question comes down to like narrative. Is AI a bubble? Are the CapEx going to stop? If not, it's probably going to be a hold to buy. If it is, then be worried. What happened to REITs? You were bullish in 2023, but they didn't pop. Most of them are down at the same levels. Interest rates didn't move. So REITs are going to be primarily driven by interest rates. So like valuation of REITs is going to be primarily driven by interest rates. So if we don't see the long end of the curve come down, then you're not going to see valuations pick up. And that's going to challenge the real estate space in terms of capital raise and the like. So it's going to be just like a prolonged thing. And if you held all the way through that, congratulations. But yeah, it's not going to be an immediate reward. Any thoughts on gaming industry or the stock you buy? If you had to buy one sector, no Microsoft. Gaming industry, no. At the right price, I would have loved to pick up Games Workshop. Yeah, I think this is about REITs. Yeah, no, some REITs did fall 50-80%. Land REITs that pay dividends, no. I mean, they're gonna be. It's all about the spread they generate. So I think you're maybe talking about what's that one called? There's one with the ticker symbol land. I forgot that they're basically really hyper tied to long-term rates. But anyways, the whole point on that is like, yeah, this is the problem if you get married to an idea. If you have, let's say 10 ideas and you marry all of them and you don't remain adaptable, yeah, you can get hurt easily. So like in the case of REITs, for example, it became pretty evident that the long end of the curve isn't really going to move. So you have time to just like, hey, exit and then reevaluate and come back to it at a later point in time. You can miss like the first 10% and still do fine. Some of the REITs, like I think KRC is one of the ones that is recovering. Yeah, it's at $40-ish. And if you want to call that a recovery, so probably with like dividends, you got like a positive return, but not a very compelling return. And then other ones like ARE broke down tremendously. Realty Income's underperformed. I think Agree, depending on when you bought it, did okay. Some office REITs recovered better than others. Highwoods Property Trust is one that comes to mind. Safehold, yeah, that's the one. So Safehold, I mean, that's a bet on where long-term rates are going to go. So really always just look at this as a proxy for where the long end of the curve is going to go, if that at all. But other than that, it's a very, it's not an easy thesis. And I know Michael Dell is a huge shareholder in this, but I don't really see a structural compelling reason to own this. But if you have a prediction on where long end is going and you think it's going to go down, then yeah, this could be a very interesting long-term trade. Or sorry, short-term trade. Well, short to medium-term trade. Like it could have legs for a few years. ADC and or flat. Well, depending again on when you bought. So like I know there's members who bought Agree Realty at a pretty attractive price and they're up quite a bit on it and including dividends. And then some of the preferreds for these, like the debt of these entities has been pretty good. better returns than the equity. So no thoughts on Qualcomm. My partner Andrew is not very. He's not too bullish on them. He's not necessarily bearish, but he's not bullish. That's the last comment. Did I see the insiders buying Fiserv? A lot of super investors will grant and then good trade for 90 days. Not sure. All I know is I looked at Fiserv when a lot of members asked me to look at it. Didn't like it. Thought, there's a lot of problems with it. It was they were at the upper end of their leverage target. Not much room to move. Lots of problems with if there's any mistake or error in anything, you slip up and you fall hard. That's what happened. Insiders buying, it's like, okay, don't really see that as signal other than like desperation perhaps to spark some interest. I don't like Clover because I like Toast, to be clear, and I don't like their banking core business because they have something that actually is gunning for disruption. And so if the company I'm invested in actually succeeds, then I have a lot to gain and they have everything to lose. So yeah, because it's just hard to break into at least one of them and have a case study for like why that works, and it was seamless. And so if you get one of their customers to move over, quickly they could cascade and lose a bunch of customers because their customer satisfaction is very low. Actually it's expensive, but if you pay for services that actually get you, like the industry interviews, you can just I'll just paraphrase what one of them did, but it's also known. If you talk to people working in the industry, that they'll tell you. But the interviews basically go something like that. There's a lot of dissatisfaction with the products that Fiserv has. So like the banks themselves look at them as like a detriment to their own innovation. And so they would get off of them if they could, but it's just too much of a hassle and too risky. But there's companies out there that are trying their best to make it happen. And I think one of them in particular is going to make it happen in the not too distant future. And if that's the case, then that could be very problematic. Then we start asking more questions on like, do they go bankrupt or not? Rather than, so I don't really care for Fiserv. I think there's much better companies out there for roughly the same valuation, by the way. So okay, so I think we covered all the questions. We got through them all. Look at that. Dun, 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 dun. All right, and we went off for 2 hours, so lots of content for you guys. All right, with that being said, I'm going to go and absorb what the hell happened to my Lululemon trade, because that was beautiful and very distracting. I had a hard time getting through the middle of this live stream because of that. Well, actually, let me go over it live, I guess. So what the hell happened? So I think it finished off. So 207 ish. Let me see. I bet you they're already listening in on the earnings. It looks like Andrew already did. Oh, I'm just getting tagged now. Oh, I did say if it was 10% exactly. Oh, I meant to say if it was down 10%. That's why they punished you, Fuhad. I'm sorry. I meant to say if it was down 10%, I was going to ban you. They all interpreted it as orders to ban you if it was up 10%. Because I misread Winnie's comment. Oh no. Oh, the Game Awards tonight. We'll see who wins Game of the Year. GLW. No thoughts on GLW. Okay. Yeah, I'll probably look at these earnings. I'll grab some food and get to looking at these. All right. With that being said, guys, thank you guys so much for joining me tonight. And I'll be seeing you guys on the next one. And remember, if you guys are interested in any or joining the Capital Mindset Club, the link is in the description below, as well as looking at my affiliate links for FinChat that helps support the channel. And if you're looking for tax services, also look in the description below for our affiliate link to Strongman, who will gladly do your taxes in the United States. I'll see you guys on the next one.
Okay. We'll do it live. Okay. We'll do it live. F it. Do it live. I'll write it and we'll do it live. F***ing thing sucks. Yeah.